All right, we are almost through chapter 2 and things are going to start getting a bit more interesting. So if you've made it this far, congratulations and great work, because all of this boring stuff that usually comes in the beginning is almost done. So let's go ahead and get right into video number 16. This video is going to be all about moving averages. So moving averages are pretty important in any trader's strategy. From traditional portfolios to cryptocurrencies like Bitcoin and Ethereum, the use of technical analysis indicators have one simple goal. That is to use existing data to make more informed decisions that will likely lead to desired outcomes. As markets grow increasingly more complicated, the last decades have produced hundreds of different types of technical analysis indicators, but few have seen the popularity and consistent usage of the moving average. Now, although there are different variations of moving averages, their underlying purpose is to drive clarity in trading charts. This is done by smoothing out the graphs to create an easily decipherable trend indicator. Because these moving averages rely on past data, they are considered to be lagging or trend-following indicators. Regardless, they still have great power to cut through the noise and help determine where a market may be heading. Now, different types of moving averages. There are various types of moving averages that can be utilized by traders not only in day trading and swing trading, but also in longer term setups as well. Despite the various types, the moving averages are most commonly broken down into two separate categories. We have the simple moving averages, or the SMAs, and the exponential moving averages, or the EMAs. Depending on the market and desired outcome, traders can choose which indicator will most likely benefit their setup.
The moving average is a tool commonly used by traders and technical analysts to analyze the price movement of securities. The moving average is simply an average of a series of data points over a given period of time. Traders use moving averages to smooth out fluctuating data in order to identify overall trends and cycles. There are two types of moving averages that are most commonly used by traders: the simple moving average, SMA, and the exponential moving average, EMA. The simple moving average is the mean of the data points. For example, if you were using a 20-day moving average on stocks, the price for each of the past 20 days would be added together and then divided by 20 to generate the moving average. As new price data is added each day, the 20-day moving average shifts forward, always using the latest 20 available data points. Each data point is weighted equally in the simple moving average, regardless of whether it happened yesterday or 20 days ago. Similarly, an exponential moving average will also take an average of the data points over a given period of time, like the simple moving average. However, the weighting of each data point is not equal. More weight is given to the most recent data, and the weightings decrease as you go farther back in time. In other words, the exponential moving average treats recent data as more relevant and more important compared to historical data. In investing, traders are always looking for signals to buy or sell. By weighting recent data more heavily, exponential moving averages can give traders clear trend signals faster than the simple moving average. However, this can also increase the number of false signals. For this reason, many traders use an exponential moving average in combination with a simple moving average.
Now, how to use moving averages. So because moving averages utilize past prices instead of current prices, they have a certain period of lag. The more expansive the data set is, the larger the lag will be. For example, a moving average that analyzes the past 100 days will respond more slowly to new information than a moving average that only considers the past 10 days. That's simply because a new entry into a larger data set will have a smaller effect on the overall numbers. Both can be advantageous depending on the trading setup. Larger data sets benefit long-term investors because they are less likely to be greatly altered due to one or two large fluctuations. Short-term traders often favor a smaller data set that allows for more reactionary trading. Now, within traditional markets, moving averages of 50, 100, and 200 days are the most commonly used. The 50-day and 200-day MAs are closely watched by stock traders and any breaks above or below these lines are usually regarded as important trading signals, especially when they are followed by crossovers. The same applies to cryptocurrency trading, but due to its 24/7 volatile markets, the MA settings and trading strategy may vary according to the trader's profile. Crossover signals. So naturally, a rising moving average suggests an uptrend and a falling MA indicates a downtrend. However, a moving average alone is not a really reliable, strong indicator. Therefore, MAs are constantly used in combination to spot bullish and bearish crossover signals. A crossover signal is created when two different MAs cross over in a chart. The bullish crossover, also known as the golden cross, happens when the short-term MA crosses above a long-term one, suggesting the start of an upwards trend. In contrast, a bearish crossover, or a death cross, happens when a short-term MA crosses below a long-term MA, which indicates the beginning of a downtrend. Now, some other factors worth considering. The examples so far have all been in terms of days, but that's not a necessary requirement when analyzing moving averages. Those engaged in day trading may be much more interested in how an asset has performed over the past 2 or 3 hours, not 2 or 3 months. Different time frames can all be plugged into the equations used to calculate moving averages, and as long as those time frames are consistent with the trading strategy, the data can be useful. One major downside of MAs is their lag time. Since moving averages are lagging indicators that consider previous price action, the signals are often too late. For instance, a bullish crossover may suggest a buy, but it may only happen for a significant rise in price. This means that even if the uptrend continues, potential profit may have been lost in that period between the rise in price and the crossover signal. Or even worse, a false golden cross may lead to a trader to buy the local dip just before a price drop. These fake buy signals are usually referred to as a bull trap. Now, moving averages are powerful TA indicators and one of the most widely used. The ability to analyze market trends in a data-driven manner provides great insight into how a market is performing. Keep in mind, however, that moving averages and crossover signals should not be used alone, and it is always safer to combine with different TA indicators in order to avoid fake signals.